Why do some people retire with financial freedom and others struggle and scrape just to get by, despite these two different people making similar incomes before retirement? I asked myself this question in 2010, and I've learned a lot. And now I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Welcome to Financial Fountain of Freedom. My name is Brad N. Reed. I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. We're in a series about the stock market. Later on, we're going to talk about multifamily real estate and then take some of those uh, strategies into private equity and maybe into some oil and gas and other energy type stuff. So we can all build a balanced portfolio together. Specifically, in this episode, I'm going to introduce candlesticks and we're going to talk about some reversal and continuation patterns. And 2 weeks from today, in episode 8, I'm going to talk about how to build and test a trading strategy. That's a fun one, a valuable one. And that's kind of where we take all of the stuff we've been talking about the last couple of episodes, put it together so you can build a trading strategy. And then we will go on to talk about other things, indicators, options, and how to get more complex. I will be developing a 4-tier education system here. And we are in the one called Dominate, number 3, Invest for Success, where you learn to invest for yourself. Don't pay someone else to underperform the market. Build multiple streams of income and achieve your financial dreams. But realize the first step in the system is to learn how to be good. And by be good, I mean get out of debt because debts compound. We've already talked about compound interest and how those things can grow. And if you got debt growing against you, that's not equity debt, like mortgage on a house is okay to have, but to pay for weeks and weeks and months on a sushi dinner you had a year ago, that's not good financial strategy. So get out of bad debt. Number 2 is align your mind, body, and spirit. Folks, this stuff is hard. This stuff is new. And once again, I come back to the biggest tip that I've ever gotten is you are the average of your 5 closest people. So look at your 5 closest people. If they are not going where you want to go, as far as your finances, your spirituality, your relationships, your health and fitness, then you need to find a new group of people. In fact, my wife and I are doing an Instagram live at 11 a.m. Eastern every Monday. And we're going around this concept called the circle of life, where you talk about the major areas of your life. Uh, we identified spirituality, relationships with your spouse, relationship with your kids. Later on will be relationship with your kids, with your friends. Then there's health and fitness and business, but you decide what are your key areas and identify how to fix them and to improve them and make sure that everything is functioning together like a wheel. And then the final step is live your dreams. When you have made your money, when it is rolling in faster than you spend it, how do you keep it? How do you give generously to your community, but keep that money machine flowing? We don't want to be these people that win the lottery, or even though we build it, but 90% of people that win the lottery, they are bankrupt in a year or 3 years. So once you have built your many streams of income, how you continue to grow it and live a fulfilling life. Money does not buy happiness. So how do you be fulfilled when you have financial freedom? All right, this is not financial advice. This is for education. Hopefully some entertainment value in this. But should you need personalized advice, please seek a competent and hopefully licensed individual in your area. I might be talking about some securities. I might be talking about some investment opportunities, but none of these constitute an offer to buy. Those are between you and your broker dealer or a PPM should that arise. Okay, no advice here, no investment advice, tax advice, accounting advice, or legal advice. All right, folks, there's a 4-step process that I went through that really woke me up back in the early 2000 teens. Interest rate matters, folks. There's a lot of people that want to tell you this is what you get and this is what you should be happy with. There are many different ways to invest. And if you are not getting the interest rate that you need, find a different way to invest. Inflation increases the cost of living. Just this last couple of days, I was sitting on the back porch with a buddy of mine who was not yet here. And I was saying, dude, how are you investing? Because his goal was 3% a year. And I'm like, that's not even keeping up with inflation. And then I explained to him that in 36 years, the cost of living will quadruple. And he said, oh, I don't know if that's true. And I was like, bro, that's math. 4% inflation. The cost of living doubles in 18 years. It quadruples in 36 years. And then we got out Chat GPT, and he still said, I don't know, man. So look, denial is a strategy, but it's not a strategy for success. You need to calculate your required inflation adjusted rate of return and then compare that to what you're currently getting. If you need to make a change, make a change. If you do not need to make a change, don't make a change. But going through this process, I figured out that what I thought was going to be a financial fountain of freedom in retirement was more like the retirement dumpster fire picture you see there. Here's where you can go get that calculator. It is free. And yeah, a very non-humble brag, flex, whatever. I built this before AI. I did have AI check it. AI was very confused, but I straightened AI out. It's not an easy calculator to build. All right. We are here because you want to build your financial freedom along with me. Money mindset determines your financial future. There's a reason. Tier 2 in my program is align your mind, body, and spirit. And tier 3 is dominate and build your multiple streams of income. So fix your money mindset before or during you go through this process. Calculate your desired rate of return using that calculator right there. And then structure a great portfolio that is, according to the Ray Dalio advice, it's diversified. That means different flavors of different investments, non-correlated. If one goes up, the other one doesn't, it's not predictable, right? Non-correlated means non-predictable. If one goes up, you know the other's going down. Those are correlated. You want diverse investments that are diversified, non-correlated, especially with the stock market, and have asymmetric risk reward. Asymmetric risk reward means the upside, if things go fantastic, are significantly bigger than the downside if things do not go fantastic. And then when Peter Mallouk reported that his high net worth individuals have 40% of their assets in real estate, 30% in private equity, only 15% in public equities, some of which are stocks, 10% in energy, 5% alternatives. That's when the light bell went off. Did I say light bell? Wow. Okay. Yeah, that's when it all kind of came together. And I discovered how to create my financial fountain of freedom. And I started putting my money to work. Be sure that your portfolio serves your needs for cash on cash or equity growth. I have not reached my retirement years yet. So I am more focused on equity growth. I know several people that have met their retirement years, and they're more focused on cash on cash. All right, Indomitable Horizons Fund has investments now. Particularly, we have one that is more of a cash on cash investment. So if you are ready for that, swing on over to indomitablehorizons.com or indhrs.com, find the contact page and schedule a meeting. It is for accredited investors only. And again, that offer is governed by a document called a private placement memorandum. All right, folks, as we jump into the review, remember how we learn 10% by reading and listening and watching videos like this. Only 10% of the skill that you need. 30% is by discussing it with others, hence get a tribe of your 5 closest people. And 60% by doing it. And again, the whole point of doing it, next week, or sorry, in 2 weeks on episode 8, I'm going to talk about building a trading plan, doing something called back trading, where you go look at real life data, but you get it instantly. So you don't have to wait for years or or weeks, and also paper trading, where you practice with real money. That's where you're going to get a lot of the 60% by doing it. All right. We're talking about stock market education, multifamily, private equity, and energy is coming later in the series. These are some of the strategies and the abilities that you will learn if you stick with this series. All right, review. How many higher lows do you need to call it an uptrend? The answer is 3. When you do find an uptrend, mark it with a line, make a parallel line, and draw that at resistance. And then your trading strategy is to buy low and sell high. When it comes when it approaches support, you buy. When it approaches resistance, you sell. Rinse, repeat. It will not always work. So when you win big. When you lose small. That's called asymmetric risk reward. That's an uptrend. 3 consecutive higher lows where you can connect them with a straight line. A downtrend is 3 consecutive lower highs that you can connect with a line. Draw that straight line at resistance, make a parallel line, draw that at support. You can sell high first and buy low to close. Sell to open, it will not always work. So when you win big. When you lose small. Sell high, buy low. Sell high, buy low to close. Sell high to open, buy low to close. When you got a sideways market like this, you can still draw your line at support. That's down here at the bottom. Draw your line at resistance. That's at the top. When the stock comes close to support, you buy. When it gets close to resistance, you sell. When it gets close to support, you buy. When it gets close to resistance, you sell. And if you want to double up, when it gets close to resistance, you sell and buy to close. Buy to open, sell to close, sell to open. Maybe you lose on that one. Sell to open, buy to close, buy to open, sell to close. So you just trade it both directions. All right, an ETF is a basket of stocks that trades on the exchange like a single stock. You can get market ETFs that follow the major US indexes or international indexes. Fun fact, you can also buy an ETF that tracks Nancy Pelosi, one of the greatest traders ever. You can also get an ETF that is the inverse of Kramer, one of the worst traders. Well, I shouldn't say that. But there's a very famous consultant or advisor, goes by the name of Kramer, and evidently very entertaining because he's been on the news for decades. But there are ETFs that win at a fairly good rate by just doing the exact opposite of what he advises to do. A sector is a group of companies, so you can get ETFs on the sector. An analyst is a Yahoo who publishes research and price targets on companies. This professional can be biased. This professional can be hired by the very company who they want their stock to go up. So they hire a professional to write a good article about their stock. Be really, really careful when you read these headlines and these articles. A brokerage is a company that you go to buy and sell orders. I use Schwab. This referral link will be in the description of the YouTube video when that comes up. An exchange is like a market. Well, it's not like a market. It is a market where stocks and options are bought and sold. And a market maker is the firm or the entity that actually does the buying and selling. This is important because the market maker controls the ask and the bid. If you are buying, you will buy at the ask. If you are selling, you will sell at the bid. Traditionally, the bid is lower than the ask by a couple of pennies, sometimes bigger, but that is the market maker profit. If this concept is confusing to you, some of y'all that saw the previous episodes, I asked AI to do this for a week and AI couldn't do it. AI kept messing it up. So yes, it's complex. Just remember, you buy at the ask You sell at the bid. Now, when we get into options, you don't have to do that. You can negotiate with the market maker. And that's a mind-boggling way for some people to increase their profits by 20, sometimes 30 or 50%. It's amazing. All right, two ways how I like to measure the market. One is the Shiller PE ratio, the other is the Buffett indicator. And for those of you that are following along, come on. The Shiller PE ratio has officially reached the second most overpriced in the history of since Noah walked out of the ark. Okay. Since Moses led the Hebrews out of Egypt, we are the second most overpriced since then. Um, had a buddy share with me why he doesn't like the Shiller PE ratio. You can check out my Facebook if you want to see that discussion. I still think it's a pretty good indicator that we're overpriced. Doesn't mean we won't go up, doesn't mean we cannot continue to go up. Just means that I think that we are overpriced. All right, jumping back into it. Support is the floor where stocks tend to find a bottom and they frequently bounce off of support. And when they do bounce off of support, they go up to the next resistance, which is the ceiling. And when they get to resistance, if they get rejected, they will go back down to the next support. And then we will see if they go across the next support or if it'll bounce back up to the next resistance. We sometimes call these pivot points because old resistance, when it gets broken, tends to become new support. Similarly, new support, if it gets broken, tends to become new resistance. So sometimes we just call these pivot points. We're going to have a little game about identify the order types. I'm going to go fast because this is review. But number one, if you want to sell at this price or higher, what order type is that? You want to sell at the purple line or higher. That will be a sell limit. Feel free to type it in the chat pane if you're here. Again, I'm going to go fast because this is a review. If you don't know these, you need to learn these. You need to get these into your body so that these are instinctive. Sam's asking about market orders. Market orders are subject to a lot of manipulation by the market maker. So I like sell limits when I can do them. But for two of these order types, I will be doing market orders. The next question is, I don't want to buy until it gets up to the green line, and then I want to buy at the next market offering. I don't want to buy until it gets to this green line, and then I want to buy at the next market offering. Technically, we'd say I don't want to buy until it gets to the stop price, and then buy at the next market offering. That's a buy stop market. And then for the protective stop in this situation, I don't want to sell unless it gets to this stop, and then I want to sell at the next market price. So that's called a sell stop. Don't sell until you get to the stop number, and then sell my shares at the next market offering. And sometimes that next market offering can be far away. All right, number 4, down here, if you got a bearish trade, you want to buy at this price or lower. You want to buy at this price or lower. That is a buy limit. If you want to enter in on a short sell here, on a short trade, you don't want to sell until it gets to the green price or lower. When it does get to the green price, you want to sell at the next market offering. That's going to be a sell stop market. And then your protective stop up here is going to be a buy order, right? Because if you sell to enter, you want to buy to close if it goes against you. And so that's going to be a buy stop market. You don't want to buy until it gets to your stop price and they get filled at the next market offering. Again, if those are new to you, review it. All right, here we go again. I don't want to sell until it gets to this price or higher. That's a sell limit. If you get a big breakthrough, your pivot point, and you want to buy on the retest, you want to buy if it pulls down, you want to buy at the green line or lower. That's going to be a buy limit. And again, the protective stop, you don't want to sell until it gets to this number, and then you want to get filled at the next market offering. That's going to be a sell stop market. Number 4 down to here on the bearish trade, if you want to get filled at your target, you want to buy to close at the purple line or lower. If I want to buy at this price or lower, that's a buy limit. If a if it makes a big bearish move through your pivot point and you want to get filled on the retest, if it comes back up to the green line or higher, if I want to sell at this green line or higher, that's a sell limit. And then for your protective stop, if you want to say, hey, I don't want to buy to close until it gets to this red line or higher, that's going to be a buy stop market. Review those if you're watching this. Yeah, there you go, Sam. I see you on the chat pane. Thanks for being here, Sam. All right. And then we talked about a concept called a trailing stop. You can tell your broker, hey, if I want to keep my stop $3 or 20 cents or $5 or whatever you pick from the most recent high, and the broker will adjust your protective stop for you. You can also do that as a percentage. I like to do a manual trailing stop. So if I get in a trade, I might have a protective stop right here. And then after it makes this high, maybe I come up to break even. And then I see this bounce. I think, hey, it just made a higher low. Is it going to make a higher high? When it does, I'm going to raise my protective stop to here. Boom, big old move. When it starts to retrace and go again, I'm going to raise my stop. I'm going to raise my stop. This kind of slow movement. After it went fast here, slow there, I'm probably going to get a little scared. Not scared. I'm going to follow my trading plan. And I'm going to raise my stop, raise my stop, raise my stop. This is all me manually trailing my stop. And then when I see this action right in here, I'm at least going to move my stop to there, probably up through there, because as we will talk later on, this is a flavor of a double top. That's a reversal pattern, and I should expect it to go down. Hence that purple line there. That's where I exit. So trailing stops, you don't have to leave your protective stop, and you can adjust your target as well if you think it's going to come up short. All right. But never lower your stop. Exactly, Sam. Sam's been reviewing. Yeah, Sam, that's a key point. I'm glad you brought that up. Thank you. Never lower your stop. Your protective stop should be set at where your max gain, your max loss will be. And so, yeah, we're going to talk about candlestick charts and gaps, reversal and continuation patterns. This is a candlestick. When you have a white bodied candle like this, or sometimes a green one, white and black are better. The open is always the bottom of the time period. The lower wick shows the lowest the stock went in the time period, and the high is the highest it went in the time period. And then the top of the body is the close. Now, this one candle here can represent a minute, an hour, a day, a week, a month, a year, you pick. I've seen people that, what is it? Is it 5.27, 72 minutes or something like that? Because they like to have 5 candles in a stock trading period. I don't know. You can make this whatever time period you want. But anytime you have a white body or a green body, the bottom of the body of the candle is the open, the top is the close, and the upper wick shows the highest it went in the time period, and the bottom of the wick shows the lowest it went in the time period. Now, this is a fairly new way of charting stocks. By new, it's about 140 years old. And this strategy originated in Japan to track the price of rice. And wicked smart rice traders 140 years ago in the 1880s, 1890s in Japan would know when to stock up on rice, when to sell lots of rice by tracking charts with candlesticks. All right, a bearish candle is going to have a full filled in body that's black, sometimes also red. But when you have a bearish candle, the open of the time period is the top of the body. The close of the time period is the bottom of the body. The upper wick shows the high in the time period, and the lower wick shows the low in the time period. Look at these for about 2 weeks. If you look at line charts right now, switch them over to candles, your eyes will adjust, but only if you look at these a lot. Um, I do not like red and green candles. I like white and black candles. When I am looking at my stocks, every single color on my stock chart is an indicator. Blue is significant pivots. Light blue is minor pivots. Green is entry. Red is protective stops. Purple, you don't need to know all this, but I'm just telling you how specific I am. Purple are targets. Light blue is a 100 simple moving average. Pink is the 200 simple moving average. Magenta is the volume weighted average price. Brown is the 10 moving average. Navy is the 20 moving average. And purple, or a dark purple, is a 50 moving average. So every single time I see a color on my chart, my brain is pre-programmed to know instantly what that color means. However, on my trading platform, Thinkorswim, the white and black candles do not show up very well when they get small. If you have a trading platform or a monitor that allows you to do white and black candles for bullish and bearish, I highly recommend that. Okay, these wicks are important. These wicks tell you who is winning while in the time period. So if you see a long upper wick like this will almost always represent that the price action opened here. I know it opened there because that's the top of a bearish candle. And at some point, we got all the way up here. The buyers were crushing it. And then the sellers came in and said, oh, yeah, you're done, and shoved it all the way back down. You see a candle like this, there's a good bet it will continue bearish because this upper wick means that the sellers won in the middle of that time period and it closed lower than where it opened. Sellers are in control. It is likely to continue bearish. Even more so when this happens at resistance. This long lower wick down here indicates the opposite. We opened here because it's a bullish candle. At some point in this time period, we opened here. We know that. At some point, it got up to there and then came all the way back down here. And the bull said, hey, it's a value down here. We're buying, and pushed it back up. Now, I don't know if this low happened before this high. Maybe the high happened first. Maybe the low happened first. But I know over the course of this time period of this candle, the sellers were winning and the bulls took over and the bulls crushed it. On a candle like this green one here, the bulls dominated for the almost the entire time of this candle. That's a very strong indication of a strong bullish push during this time period. Same thing with this bearish candle. See these really small upper wicks and lower wicks? The bears dominated almost the entire time period. This guy is called a doji. This thing is called a doji. A doji has a really small body and long upper wick and lower wick. This represents a battle. A battle just happened between the bulls and the bears. We don't know who won yet, but likely someone's going to win because there has been wild swings up and down. And when it came time to end it, we don't know who won. It opened very close to the clear. So let's see how we put all these things together. Give me for a second. All right, we're going to talk about reversal patterns. One thing that's very important, folks, where they appear matters most. Reversal patterns are the strongest when they occur at support or resistance. Support or resistance. If they happen in between, maybe something changed or maybe it's something different. So And the second thing you want to look for is volume confirming the signal. And a bullish uptrend, usually bullish volume is winning. And a bearish downtrend, usually bearish volume is winning. When you have a good, strong reversal pattern, volume should spike. All right, back to this green lower wick candle. This is called a hammer candle. This is an incredibly bullish signal when it's found its support. If you are in a bearish trade and you see this guy at a support, the party may be over and it's time to play defense. It's time to tighten your stop. It may be time to take your target, right? If you have a target right in here and it missed you by a smidgen, by a penny, I've had that happen before. It missed me by a penny, and I saw a hammer candle at support because I was in a bearish trade. It was going that way. I saw that guy. I'm like, nope, I'm out. And I exited for a nice profit. Not as much as I wanted, but I got out. This thing is a shooting star candle. If you have this long upper wick up here, this means that the sellers have taken over. We were in an uptrend. We saw this at resistance. And some time in this time period, the sellers took over. If you're in a bullish trade, the party's over. Okay? Tighten your protective stop. Time to play defense. Doesn't always mean exit. Sometimes it just means be aware. Now, if you see this guy, our good old friend, Mr. or Mrs. Doji, at support or resistance, it means there is a battle. If we were in an uptrend, the bulls were winning. Well, there was a battle between the bulls and the bears. We don't know who won. It might be a continuation. It could continue on up. But if it's at resistance, that is an indicator that there may be a reversal coming soon. Many a time when I'm in a day trade and I see one of these at or near my target, I will just exit. I'm out. Or if I see one of these near the end of the day, I will tighten my stop to right there and just boom, I went out. Okay. Hammers, shooting stars, dojis. Hopefully today we can hop on a stock chart and go find some of these. Bullish engulfing candle is when you have a bearish candle followed by a significantly larger bullish candle. Notice how this candle engulfs the smaller candle. All of these bears right here, anyone who sold on this candle is now losing money. And if you're in a bearish trade, you will buy to close. So this is a good time if you want to buy to enter and you see this at support, you can say, hey, look, these bears, they're buying to close. Bulls like me are buying to enter. I may have an overwhelming edge of buyers pushing this thing upwards. Same thing on this bearish engulfing pattern. All of these bulls right here, they are trapped. They might have their protective stop right down there. And as we go down, these bulls are going to sell to close, while bears like me are going to sell to enter. And we will push the price downwards and make money doing so. So that's a very strong reversal pattern when they happen at a pivot point. This is a special kind of combination of those last two, an evening star. Yeah, sorry, morning star reverse. I have a toolbar on my Zoom toolbar covers this up. For a minute, I thought this said evening star and that said morning star, but there it's labeled correctly on your screen. This 3 candle pattern is a morning star reversal. It is a very significant reversal pattern, especially when it happens at support and with big volume. This candle over here represents a lot of bears pushing the price action down. This doji indicates a battleground happened. Notice how tiny this is. Either people were just waiting to see, or there was a very fierce battle in a small range. The bulls have won. So you can put your entry there, protective stop there, trade the breakout, or you can wait for it to break out and trade it on the retest. Spoiler, that would be a buy stop limit. That would be a buy stop market. Your protective stop would be a sell stop market. If you waited for it to break out and come back on the retest, this would be a buy limit over here. An evening star reversal is a very strong reversal signal. Bulls were winning, battleground, sellers took over. If you got a pivot point right through here, a resistance, and it got rejected at that resistance, especially on a big volume there on that selling, good chance it's headed back down for support. Not always. Not always. All right, these are some favorites. Get to know this one. This is a double top. You got to look at these over and over again to see that price action. But what this represents is that the bulls got rejected twice. And everyone who wanted to sell here, they hope they got to sell here. But if they got two chances to sell there and they didn't, as this thing goes down, all of the bulls over here are panicking. They are panicking and they are selling because they had two chances to sell high. They missed it and they are going to sell to exit, and this thing will go lower. Likewise, if you had a protective stop and you saw that gap there, you likely moved your protective stop to right in here. And as this goes lower, it's hitting more and more of these bulls' protective stops, selling their shares, pushing it lower. So that is a double top. If you are in a bullish trade and you see that, party's over right there. Time to exit. Similarly, a double bottom is an incredibly strong signal at a reversal, especially if that is at support. You can trade the breakout or wait for a retest to see if that holds. Now, I purposely drew these in a particular way that are my favorites. They don't always happen this way. That green candle represents buyers or sellers. Type it in the chat pane. Does that green candle represent buyers or sellers? And then while you're typing that in, what is happening here to those people that got in on this candle? That green candle represents buyers. So if we have a sudden influx of buyers right before we break lower, do we have a lot of people or very few people that are trapped and will be selling to close? Spoiler alert, it's my favorite because we have a lot of people that are trapped and selling to close. I don't like people losing money, but if I'm going to trade this thing bearish, I love having a bullish candle right there because that indicates more people selling to push this thing down. Similarly, if I have a bearish candle there, that represents sellers. Holy smokes, y'all. I got 3 bearish candles. If this is a daily chart, I got 3 days of sellers that are all trapped and losing money as this thing goes higher. So when you look at these charts, these reversal charts, think about who's profitable and who's not, and how are they going to behave. Okay, this one's called a head and shoulders or an inverted head and shoulders. It's basically just another flavor of a double top, but instead of 1 or instead of 2, you get 3 bumps. Head and shoulders is when you get a small bump, a big bump, and a small bump, right? That's a shoulder, that's a shoulder, that's a head. Just another way to say, why did that show up? It's another way to say that, sorry, I had this weird window pop up over here. It's another way to just say that there is strong support here. And if it breaks, all of these people may be selling. Similarly, over here, we got this one's kind of a little bit wonky, but Shoulder, shoulder, head, and inverted head and shoulder is a bullish pattern. Even more so if you have bearish candles here. And oh my gosh, if these bearish candles are on high volume, this breakout will be on incredibly high volume. At least that's my expectation. Because if I were trading this bearish to roll over at this neckline, at this super strong resistance, if I'm wrong, I have a protective stop up here. I have a buy stop market. And when this goes higher, my bearish position is going to buy to exit, and my bullish position is going to buy to enter. So again, look at who's making money, who's losing money, and how are they going to behave. Okay, pause on this one, folks. Get out your cell phone. My cell number is 317-777-0767. If you see a rising wedge or a falling wedge, you frickin' text me. If you see one of these, you message me. If you only have my social media, message me there. I hope I see it in time. These things have an incredibly high probability of breaking in a predictable fashion. They're my favorite. They're really rare. They are really hard to find. But if you find them, bam. And it's confusing. This is called a rising wedge because it's going up. But when it breaks, it's going to break hard. It's going to break strong. Sam, I know you do directional options. I am definitely trading this thing on an at the money or potentially an out of the money option because they tend to move fast. On the falling wedge, these things break bullish. I will trade these aggressively. I will not lose more than my maximum loss, but I will take a leveraged position. I like these. And folks, I'm not kidding. If you see one of these, text me 317-777-0767. All right. Continuation patterns. These generally happen between support and resistance, and volume is your confirmation. Volume usually falls off in a continuation pattern. It's usually just a resting pattern. If we're in a bullish trend and you see one of these, it's the bulls resting, a few people taking profits before it continues. If it's in a bearish trend, you'll see these in the middle. It's just taking a break, a few people closing, and then before they pile back in and send it on down. The two most common are a flag pattern, the bull flag, that's a bear flag. A pennant is when they kind of converge. Don't confuse that with a wedge. It's not a wedge. That's a pennant. Okay. Again, these usually happen in between support and resistance, and it's just a rest. Watch for volume. If you see volume really drop off in these, it's a good indication that it's a continuation pattern. You should see high volume on these, low volume here, high volume here, high volume on these, low volume there. All right, continuation patterns. I'm going fast. Again, you're only going to get 10% of the skill by listening and watching the videos. This is a particular kind of pattern called a rest after battle. In a bullish trend, you got two big bullish candles, and you got two, maybe three, maybe four, potentially five bearish candles in between. If it is exactly like these pictures, it's called a rest after, this one's called a rising three. This one's called a falling three. And folks, I'm just showing you a few. If you really want to get geeky about this, there are hundreds of reversal patterns and continuation patterns. There are a bunch. They all have one thing in common. Look at who is making money, look at who is losing money, and anticipate how they are going to respond. Maybe you use these continuation patterns as your rule on when to raise your protective stop. If you see a bullish rest after battle and it does continue bullish, maybe that's your sign to raise your protective stop. Or if you see one of these and it fails, maybe you want to lower your target. Uh, this is a continuation pattern that can happen at support or resistance. These are nice. I really like trading these. If you see an ascending triangle like this, just notice that the highs are consistent, but the lows are consistently getting higher. These traditionally will break through resistance. You can trade them with a buy stop market if you want, but if they break through, they usually come back and retest, not always, but sometimes, and then you can get filled on a limit order. The reason you would want to wait for the limit order is if you get faked out. Maybe you just get a little poke, boop, and then resistance holds. Maybe you drew your resistance line just a little bit too low. Your resistance line should have been up there, and it broke through, got rejected. If you did a buy stop market here, you would have not gotten filled and you would have not lost money. If you had a buy limit, sorry, you waited for it to make a big, strong move. That's why we use the. I don't think I said that right. I'm going to start over. If you have a buy stop market here and it pokes through there and gets rejected, you're going to lose. But if you if you have a wait for it to make a big move and then have a buy limit, it may not come down low enough to fill on your limit order. So pros and cons, we'll talk about building a trading plan next week, and you can decide if you want to wait for the retest or take the breakout. Descending triangles work the same in the bearish direction. Consistent lows, consistently lower highs, and it's just building up pressure to break through support there. Those are fun. I like trading them. Spoiler alert, I picked the ones that I like. Question on continuation or reversal patterns, type them into the chat. The last thing I want to talk about are gaps. Gaps should be rare. Gaps are when there is a sudden change in the sentiment of the traders of this particular equity. Because according to this chart, it closed here in one time period. Let's call these daily charts. And something happened overnight that the market maker just completely skipped. No one wanted to have any action in here. And the price jumped all the way to there. Something big happened. And gaps usually continue in the direction of the gap. They can be bullish, they can be bearish. They're a little bit harder to spot with candles because you got to be aware. Got to be aware. My mom's going to be so proud. Sorry, Mom. You need to be aware of where the close of that candle is and where the open of that candle is. This in between is a gap. It indicates an incredibly strong move. Now, they don't work so much on stocks or ETFs or tickers that gap every single day. Some really low volume, some foreign indices, some foreign entities that trade with American depository receipts called ADRs. Some commodities, they trade 24 hours a day. They trade on foreign markets. They gap all the time. In this case, these gaps do not create a strong emotion of the traders because they're used to seeing them. There are two flavors of gaps I want to talk about. A retest gap happens when it gaps in the same direction as the previous candle. So here we have a bullish candle. Bulls mean it's going up, and then it gaps upwards. What does that mean? It's a retest gap because there's a lot of people that are profitable. All of those bulls, everyone in this uptrend, they are profitable. And because there are so many people that are profitable, it's likely to retest. Retest just means that there's going to be some sellers. There's a lot of gap theory, study people, whatever you want to call them, that claim every gap will fill. A retest gap will fill sooner. Fill just means eventually at some point it'll come back down to there. It'll fill the gap. Just know a retest gap is a bullish candle that gaps up or a bearish candle that gaps down. A gap and go is the most fun because it gaps in the opposite direction. This thing closed here and opened there. All of these bulls are trapped. This thing traditionally will gap and it'll go. It'll continue in that direction because the sellers are excited now to trade this thing bearish uh, profitably. They're in short traders, and all these bulls are panicking. So, and they're selling to close. So when you got people that are selling to close and people that are selling to enter, holy smokes, well, let's get going. The same thing on a bullish gap and go. Realize this thing closed there and open there. All of these sellers, they are hosed. They probably have protective stops up in here that are buy to close orders. And the higher this thing goes, the bulls are happy. The bulls are buying the breakout. They're buying to enter. These people are buying to close. You get an overwhelming number of bullers that are pushing this up. Cool, fun fact. On your own time, check out something called short float. Short float is something that many stockbrokers will report to you. Short float is the number of people that are in bearish positions. It's the number of shares that have been borrowed, that have been shorted, and you can look that up. So if you know that a particular stock has a high short float and it gaps up, you don't have to guess, you don't have to wonder, you know how many bears are hosed and that they are buying to close. Uh, what was that movie that came out about the buyers that organized that short squeeze? It's called a short squeeze on GameStop, and they got on the Twitterverse and they said, "Hey, we're all going to buy at this price on this day," and they pushed up GameStop because the short float on GME was insanely high. And they said, hey, if we can push this up a little bit, these billion-dollar traders are going to have to buy to close, and we can make this thing go bonkers. And they did. They got a lot of trouble for price fixing. I don't think anyone ever went to jail, but fun movie, entertaining movie about an actual short squeeze. But it's free data. You can look it up. Look up short float. When I was day trading, we would look at this all the time. What stocks had high short float that were gapping? Wish we had AI back then. That'd be fun. All right. I'm going to pause the recording because I did not open my. All right. Well, for those of y'all that were not here live, I just went for about 10 minutes finding candle patterns, reversal and continuation. Um, since since I didn't have the recording on, I'm going to continue and go a little bit longer. So for those of y'all that are here live, thank you for being here. This is pretty much all I'm going to do. Just go look for some of these patterns. And I want to go back to the daily chart. And another ticker, Sam says, oh no, Sam, the worst one was when I did a live show for an hour on Friday afternoon and I forgot to hit record. And so then I, dismissed everyone. And then I re-recorded it only to find out that I had the mute on for an entire hour. And then I had to re-record it again a third time. And by this point, it's like 7 or 8 p.m. And my wife is like, where are you? And I'm like, oh, I'm going to do it again. But I did it because, yeah, absolutely. Stick around. Ian, you got any stocks you want me to look at? Mom, Dad, any stocks you want me to take a look at? Sam, what kind of time frame are you looking for this one? An interesting note. MU and TSM are in the same sector, and that's one reason why these charts look so similar. They both had a bullish gap and go today with a strong bullish, the strong bullish move. This looks double topish. That lower wick right there is probably a charting error. It's not real. Tim says, good point, highly correlated. Yeah, highly correlated. Exactly. That's why we want to get investments that are not correlated. Sam, see that lower wick right there? That red lower wick? That would be unusual for the stock to go all the way down there and all the way back up. There was a ticker, a chart on SPY not too long ago where the lower wick went like $400. So on a $600 stock, it went 400. That's a lot. Let me zoom in a little bit and see if we can find some more fun stuff. Hammer there, doji there, bunch of little dojis. Interesting double bottom there. That went up. Evening star reversal right there. That's a V bottom. That's pretty rare. Bullish gap and go there. Bearish candle that gapped up. That's a bullish gap and go. And holy smokes, did it go. Back in my stock trading teaching days, we would make people do something called the 1,000 gap and go challenge. And the challenge was pick your ticker, go back as far as you can, and find 1,000 gap and goes because they are an incredibly useful signal and you have to train your eyes to do it. If you spend maybe 30 minutes a day for 10 days in a row, you can find them. And it's amazing how much faster the last 100 go compared to the first 100. Another gap and go right in there. This one retested. A bullish candle that gapped up. That's a retest gap. Beautiful evening star reversal right up in there. Okay, y'all want to see a wedge? Y'all want to see a wedge that I missed? Good old friend SPY. These are some really fun candles to look at here. I don't know if y'all were here, if I did this last time, but imagine if you had a protective stop there and it got triggered on that candle. Look at the volume on that candle. Do you think that is some protective stops firing? Absolutely. Yes, it is. And Bijan and I were actually talking about this not too long ago. The heck is this crazy run up on stupid low volume? Stupid low volume. And we were guessing that that's the market maker monkeying with the price of the stock because the volume is so low. The market maker is not making money. So they start moving the stock one way or another to get people to get emotional. It has not confirmed yet, but this might be a double top. It is not yet. Do not ever trade a pattern until it confirms. Do not ever do that. Retest gap here, bullish candle, the gap's up, and it never retested. Or maybe you call that lower wick there a retest. Okay, the wedge that I am kicking myself for missing. Kind of move that out of the way. And after this, folks, I will call it a night. Drawings, drawing tools, trend line. Take a look at this bad boy here. And this one. Right along there. That is the wedge. And if it broke bearish, you would have had to been patient. But if you could have held through that, that would have been one heck of a fun party. These things usually go really, really fast. Usually don't take that time. Come on, give me my colors. Another thing I liked with trading views, my colors. I had those much, much faster. Where did I turn that thing blue? Shouldn't swear. All right, there we go. There's the wedge on SPY that we missed. If I had traded this, I don't know if I would, if I had had a sell stop market there, I would have gotten traded, I would have gotten filled there. That would have been painful. If I had done an option play, that would have been a whole lot better. But if you could have held, right, protective stop right up in here, that would have held. Come back up on that retest, trade it all the way down, double top, triple top there with the retest. Notice the bearish volume coming in, folks. These were the signs. The biggest sign of this whole rollover, it's more complex than I'm going to go into in this series, but it's called divergence. And divergence is when basically just says momentum is running out. Look up divergence if you're interested. But you can see this thing was going upwards at a nice steady rate, and then it started to roll. See this rounding pattern? That rounding pattern is the sign that the party's over. Doesn't mean it won't go higher, doesn't mean it can't go higher, but that pattern right there says it's time to raise your protective stop. And we saw where people raised their protective stops too. They raised them to right there, and they got triggered out on that candle. Sam says, I like trading view for charts. Yep, me too. But they got expensive. So I decided to learn to use the charts here. All righty. Thank you all for coming. I guess I do have two more slides. So I can switch back over and we'll finish this up properly. Next time, we'll talk about how to build a trading plan, how to back test, which means to apply your trading plan and to test it with historical data, and also with paper trading, how to go forward with fake money called paper trading to see if the plan that you devised, if it actually works. All right, folks, fix your mindset, calculate the rate of return that you need, and then build a great portfolio that meets the rate of return that you need, that is diversified, non-correlated with asymmetric risk reward and the same asset classes that high net worth individuals invest in. We do have a raise that's going on right now. So if you're accredited and interested, swing over there. And folks, please remember, you are only going to get 10% of what you need to develop stock trading skill by watching these videos. You got to get a crew. You got to get a tribe. You got to get other people that are as good or better than you and are studying it as intensively as you are. Discuss with them and practice with them. All right, that's it for me. Follow me on social media. Hit me up if you got questions. I will answer them. And if you see a rising wedge or a falling wedge, text message me. All right, folks, that's it. Thanks for joining me. I'll see you in 2 weeks for creating a trading plan. And as always, trade on logic, not on hope. God bless you.